I'm Lex Hall for Morningstar, and welcome to another edition of Three Top Picks. Today, I'm joined by Ned Bell, who's the Chief Investment Officer at Bell Asset Management. Ned, we've got three interesting companies to have a look at today. Two were over 100 years old, I think, and one's a little bit younger. What's the first one on your list today?
Yeah, so there are three quite different picks, and so the first one is Booz Allen Hamilton, which is so it's a specialty management and IT consulting business that almost exclusively services the US federal government. So at a time when obviously the macro backdrop is pretty terrible, earnings downgrades are rampant, it's about finding good earnings, good sustainable earnings.
Yep.
And that's really what Booz Allen Hamilton is. It's servicing a captive client, not only the Department of Defense, but also things like the intelligence agencies is about 20% of their revenue. And again, it's a very stable business. They've grown their revenue at about 7% a year in the last 5 years, and earnings about 15% a year. So very, very stable, not very cyclical. On a going forward basis, it's still pretty cheap. It trades on a free cash flow yield of about 5%. We think they can grow their earnings in double digits, which puts them into a very small category of companies at the moment.
Yep.
And over 2 years, there's probably a bit over 30% upside, we think.
Okay. And the second one, or at least another one on your list, is a household name, Hershey.
Yep. Not a good one for flattening the curve, but it's obviously it's a leader in the confectionery and chocolate space in the US.
Yep.
It's a name we've known for a long period of time. Obviously, quite a defensive type earnings stream business. And again, we've owned this company on and off over the last couple of years. It's lagged a little more recently, and that's what really gave us the trigger to get back into it. But again, it's a defensive earnings stream business. They generate about 20% return on capital, so it's one of the more profitable staples companies. Free cash flow yield of about 4%. Again, it's not going to outgrow the rest of the market, but it's going to maintain its earnings. And I think in the second half of the year, as you see investors gravitate more and more towards more stable earnings, it should see a decent re-rating, and we see like 20-odd% upside in the next sort of.
Okay. Do you remember off the top of your head how long you held it for last time?
Last time we actually sold it earlier this year.
Okay.
It hit our price target, and we'd held it for about 12 months, and there's no fundamental reason for selling it. It literally just hit our price target, so we got out of it. It effectively went back on the shelf. We waited for exactly what's happened now, and that's really given us the trigger to get back into it.
Okay, all right. And the third one on the list is a company that I didn't know. It's called Genpact.
Yes. So Genpact is the best thing to come out of GE in about 15 years.
General Electric. Okay.
Exactly.
Sure.
So Genpact was basically the IT consulting business and BPO business that was spun out of GE in 2007. So in the financial crisis when they were raising capital, et cetera, and that was the start of a long, difficult period for GE. But Genpact, as a standalone business, has really started to flourish outside of the GE family. And again, like Booz Allen, they're a specialty consulting business. They mainly service things like the banking, insurance industry, healthcare, IT services, manufacturing. So they've got quite a diverse base. Again, it's not huge. It's about $7 billion market cap. So it's not a massive company. It flies a bit under the radar. But again, the growth has been terrific. They've grown their revenue at about 9% per annum for 5 years on a pretty consistent basis. And they're still getting good wins. And that's what we like about it. They're getting more and more wins. And to some degree, management consulting can be somewhat counter-cyclical. So when there's a shock event and companies are going through what they're going through now, they often call in the consultants to help them with this, that, and the other. And then so I think we like the business as a whole. Again, from a valuation perspective, it's a 6% free cash flow yield. It's trading. It's pretty inexpensive. A different type of growth. I mean, I mentioned the sales growth going forward. They should grow earnings at about 10%. So again, it's a really nice business under the radar, not that well owned, and we think there's good upside. Probably 30-odd% the next 2 years. A little bit of multiple re-rating and earnings growth.
Wow. Okay. Sounds good. So Booz Allen Hamilton, Hershey, and Genpact.
Correct.
Fantastic. All right, Ned, thank you very much for sharing your insights today with Morningstar. I really appreciate it.
Pleasure. Thanks, Lex.
I'm Lex Hall for Morningstar. Thanks for watching.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.